sharing, or maybe you're recording. It says recording.
Yeah.
Okay.
You know what? I'll send it over.
You can upload it to me. That's fine. Yeah.
Absolutely.
Okay, everyone. We'll get started. Welcome to this presentation. Stephanie Sang and I are hosting this for new career physicians and residents and fellows. A lot of common things that you guys have concerns about that may be, not addressed in typical financial advisory presentations. And so Stephanie's done this for many groups. She's presented some of these topics. I talk about some of these same concerns and topics on my podcast, Dr. Money Matters. And so we thought it'd be nice to, in the era of Zoom calls, to kind of get a group of people who are interested in these same topics and kind of go over these same things and give you the opportunity to ask some of your questions, which sometimes may not be addressed by a typical presentation. So Stephanie's going to do the presentation, but we'll, definitely have time for some questions and answers at the end.
Yeah, and thank you all for also putting some additional questions when you signed up and everything. So hopefully all of this information should address most of the things in there, but there is a chat. If you guys are familiar, I know we're all getting a little more familiar with Zoom, but there's a chat box. Or honestly, you can just unmute yourself if you have any questions. We want to make sure we keep this informal so you guys can get all your questions addressed this morning. So to get started, just a little background about us specifically. North Star Resource Group, we're a very large independent firm that specializes in working with medical professionals around the country. So we are a national firm, but I think the nice thing is about the way that we work is we are comprehensive advisors. So we're not just looking at one aspect of your financial situation. As you can see from the side, it's taking a look and really getting a snapshot of everything that you have going on, and then making sure that we're addressing all aspects of your financial situation. We find this unique for a lot of individuals in your position who are, what we consider in that training phase and really making that transition into practice, hopefully in the next couple years or maybe even sooner, maybe at the end of the month. But these are some of the things that we have focused on in this presentation is things we've seen for people in training specifically and that are making this transition. There's a lot of different financial topics, and then it'll become even more verbose once we get, once you transition into practice, but hopefully we can address things that are going to be important for you today. For me personally, I am a CFP, which is a certified financial planner, and also my background is in tax. So I originally was in tax accounting, so I'm a CPA as well. So that really helps with a lot of the planning aspects of what I do. But that's just a little bit about us. So what we wanted to do was really just give an overview of the different things, and I know we mentioned this in the email that was sent out, of the different topics that we thought were important for you guys. So when we talk about this, it's budgeting, cash flow. I know it's, we have unlimited wants, but limited resources, especially right now before you transition. So trying to manage that along with student loans. I also want to purchase a home. If I even have dollars left over on a monthly basis, should I be putting money towards retirement while I'm still in training? So we're going to be addressing a lot of those different topics, as well as risk management. I know there were some questions about insurance. For us, it's not having insurance for everything, but having insurance for things that are going to be catastrophic to your situation. So we'll go through that as well. And then last of all, a couple tidbits that we've seen when it comes to contract review. Again, with specializing with medical professionals, we see a lot of contracts. I will say we are not attorneys, so we do not do formal reviews, but we do look at a lot of these things from a financial aspect when it comes to benefits, income. But there's a couple of tidbits that we've also seen to just be aware of. So we'll be touching on those as well. So first off, to kind of get started, when we talk about budgeting and cash flow, the most important thing is having a budget. And I think it's even more important when you do have those limited resources, is really trying to get a good understanding. I will say, with working with so many people in that transition phase, you're probably taking home anywhere between $3,000 to $4,000 a month. You know, income's probably between 50 and 60. If you're in any type of fellowship, sometimes it's a little bit higher. If you're doing anything outside as an independent contractor, you might have additional income coming through that way. But for the most part, it's pretty straightforward on what you're bringing in. So then the most important part is being able to manage your expenses appropriately so that we can at least keep it lean and mean right now. I will say most of the people that are in this types of, in the training position, all we're trying to do is survive at this point, get you through that training process, hopefully not carry too much debt. And I'm not including student loans, that's very different. But when we're thinking of credit card debt and so forth, and then from there, once you transition into practice, we really flip the switch in a sense, where we're looking at a lot of different aspects of your financial situation to be able to now overly fund for retirement, for kids planning, potential home purchases, any other types of investments that, you know, are of interest to you guys. So when we look at this and we talk about cash, it's hard to get to this number. So we are very understanding of that. But if you can, typically what we're recommending for people to keep in cash, because people always ask, how much should I have in cash? How much of my money should I be putting towards student loans? If I want to buy a house, what does that look like? You know, but typically we want to see 3 to 4 months of cash or emergency reserve at all times. Okay. This will not happen overnight, and we don't expect that while you're in training all the time. So this is more of a goal than it is something that rule of thumb. But if you can get as much as you can in cash, this is a perfect example of kind of what people have been going through over the past, of the unexpected things that could happen in life, that we want to make sure we have cash available to cover any type of unexpected expenses so that we do not have to turn to credit cards. Okay. You know, it's not about not using credit cards, because a lot of people use it for travel points, you know, getting cash back, any of those types of things. But for the most part, we want to have the goal of being able to pay off that high interest debt as efficiently as possible and on a monthly basis. So having that reserve is important. Also, specifically for residents and fellows, where we find people kind of forget is when they're looking at contracts, you know, and they're looking at their new positions might be in a different state, right? And so travel expenses to get there, all these different types of things, people kind of forget to build up cash for all the, you know, for these types of expenses. And then also what we find is, you know, you guys have been working, overworked, if anything, during your training. A lot of individuals that we find want to take off a month or two, you know, and then they forget that they're actually not going to be paid a salary during those times. And if your new contract doesn't give you any type of sign-on bonus, you want to make sure you have a couple months of expenses to pay so that you can actually take a little bit of a break before you get started. Because we see people get started August, September, October, and they usually take off a month or something. So just having that emergency reserve is important. When it comes to where to keep that money, I think, you know, most people keep it in their checking account or saving account within their major banks. So we're looking at individuals that, you know, their checking account, savings account, the Wells Fargo, Bank of America, Chase, all those different types. Those are ones that when you look at their savings account is going to be roughly, the interest on that is 0.05% roughly, or anything close to that. So when we're looking at a true savings account that is separate from your checking, a lot of times we want something that's going to be interest rate sensitive. So we're looking for something that's going to provide you a little bit higher interest with still not taking any risk. So these are what we consider high yield savings accounts. These are individuals that are going to, or accounts that are going to have, I would say right now, they're roughly between 1 to 1.5%. Some examples of high yield savings accounts are American Express Online Savings, Discover, Ally Bank, ALLY Bank Online, all these different types of accounts. These are going to be free. They connect to your checking account so you can transfer money back and forth. And you're actually going to get a higher rate of return. Like I mentioned, they roughly are between 1 to 1.5%. Not one's better than another. If you have an American Express, maybe you want to use an American Express online savings account because then for consistency, it's really up to you. But that would be a recommendation for any cash, and it keeps it separate from your checking. So you're truly starting to build money within your savings. The next thing is, if no other questions concerning cash, is jumping into, I know there was a lot of questions concerning debt management. I think that's really important to have a good understanding about debt, student loans. I had some questions about home purchases. So when we look at debt, we have to look at it. There's kind of two sides of the coin. There's the emotional side, and then there's the financial side. The emotional side is, oh my gosh, I have $300,000 worth of student loans. I can't sleep at night. I know there were some additional questions on how do I pay that back as efficiently as possible and as quickly as possible without also living like a resident for another 5 years on top of that. So we'll talk about that, but that's the emotional side of it. For us, when we're looking at debt specifically, we look at a financial aspect of debt. So in that sense, we're looking at it from an interest rate. How much is it costing us? How much is this debt? And where we're looking at it is a long-term debt. In the short term, we can't allocate it to any other areas to, in essence, make money off of it. So in the short term, we want to pay off debt as quickly as possible. But we truly, if we have long-term debt, so a lot of times this is home, this is student loans, any other types of loans out there that might be in a longer, there is some opportunity cost. So that's when we look at it from a rate of, not a rate of return, an interest rate. And that's where we say kind of our good debt versus bad debt is at 5 to 6%. Anything over 5%, 6%, we want to pay off as efficiently as possible or have a plan. So I know a lot of you are going to say it's, that's where my student loans fall. They're between that 6 to 8%. So we'll talk about that. But when we talk about this on paying it off as quickly as possible, this is more so individuals that have credit card debt that might cost you 12, 15, 20%. Okay. In those situations, we want to take care and build a plan to knock off the highest interest debt first and continue to go down from there. Okay. Anything less than 5%. So what we're finding right now is home purchase debt. So mortgages are probably the big one right now that fall between 3 to 4%. And we'll talk a little bit more about that. That is very inexpensive debt. So when we look at this and we say, okay, I have an additional dollar at the end of the day, where should I allocate it? That's where we have to make a decision if it makes sense to actually allocate it to something that's costing you 3 or 4% over here, or is there another opportunity, an investment strategy, real estate, anything that could help build an asset for a higher rate of return of 3 to 4%? That's not, in the long term, beating 3 to 4% is not very hard to do. There's no guarantees when you do investments, but at the same time, it's not very hard. So when we look at that, if we're going to make more money over here than what it's costing us over here, that's us becoming more like the bank. Okay. They lend money out at 4% and they give you a return of 0.05%. Who's making the money? The bank. So our goal is to continue to try to be like the bank. Okay. Some of the main debts that, again, a lot of people had questions about was student loans and obviously home purchases. Student loan options is, I'm sure you're very much aware of the different income-driven repayment plans that are out there, whether it's IBR, income-based repayment, whether it's pay-as-you-earn, repay. There's a lot of different types of loan programs that are out there. But what's important for you guys to understand is, number one, what program am I on? And making sure that your loans fit that program, okay? And what I mean by that is, one of the big things that we find a lot of residents and fellows are trying to do is the 10-year loan forgiveness, okay? And one of the big things that happened in 2018-19 was we had our first group of individuals, because loans were given out in 2008, that 2018, technically last year in 2019, there was a lot of concern because when people filed to have their loans forgiven, gosh, 80, 90% of those individuals were denied. Okay, and that was a big concern for a lot of individuals that were on this loan program to try to pay it off in those 10-year loan forgiveness. The reason that this occurred and why there was denial wasn't always denial on the full balance of the loans, but some loans were denied because back in 2008, 2009, I would say even 2010, the government didn't have the funds to loan out all these student loans that they were talking about, the federal government. So what they did is they also borrowed from private banks, used their money, loaned it out and called it a federal loan, but technically those specific loans do not count, even though they fall and you can wrap them into your income-driven repayment, they actually they're not considered for loan forgiveness. So that was one of the things that unfortunately was not explicitly told to most individuals. So what we always ask is making sure that we have, that number one, you speak, whether it's, we have a loan specialist that we use, he's outside of our firm, but because of the work that we do with medical professionals, he's great. He's been looking at student loans and helping individuals. He's more of a consultant in that sense. He's very inexpensive to get a full student loan review to make sure all your loans fit. He can only do federal because he can pull your information, but it's like $100 or something, $125 total to be able to get a full loan review. But if you don't want to utilize somebody like that, you can also call the federal, your federal loans and just make sure that they all fit if you guys are planning to use that loan forgiveness, okay? Is making sure they all fit within that. For any individual.
I'm sorry, Stephanie, I was just going to say, that's a really good point. I think we sometimes tend to get bogged down on the percentage on our savings accounts, 0.5%, 1%. And this is, a much bigger area of importance. And I think many of you would probably realize that, but it seems like sometimes on these various social media sites, a lot of people are worried about what my savings account is earning. And the bigger bang for your buck here is exactly optimizing your student loan plans, your repayment plans. It is well worth the effort, whether you do it yourself or you hire or utilize one of these loan review companies to do it. But I think that's a big thing, and especially because there's always some changes happening in these programs. They're really aware of it that maybe we don't keep aware of as much. So go ahead.
Yeah.
Sorry about that.
No, absolutely. It's definitely something to take into consideration because this is a huge part, and this is where we find the driving stressor for most medical professionals is the loans that they have kind of hanging behind them and making sure that they're doing the right thing. Because it's really hard, it's overwhelming to see loans that are the size of a mortgage potentially as, just out there. So making sure that you're taking care of that. For those individuals who do not plan to be on any loan forgiveness program because they're going to go private practice, so they don't fit within that realm, there are great private refinancing options that are available. So what became very popular because interest rates were much lower over the past couple of years is that a lot of private banks have come in to say, great, we'll buy out your loans, take over the loan. We're going to give you a much lower interest rate, and we're going to give you some characteristics that mimic that, so they have, some banks have little deferral programs if you're still in training. Some have, you have to look at each individual bank. We do use a website that is state-based. So the nice thing is it's Consumer Advocate. If you guys want to, we'll be sending out emails after just getting feedback and stuff like that. If you want that website, I can also get it for you. But within Consumer Advocate, they name the top 10 banks to refinance. So it's great because they have different loan programs that are very similar to student loans. So they have 5-year, 7, 10, 15, 20-year, some of them 20 year loan repayment structures. And then they have variable and fixed rates. So some of those, you're still going to find rates that are maybe, depending on the length of time, et cetera, between 3 to maybe 5%, depending, but they're going to underwrite you as an individual. So just be aware that that's going to be the case. So credit score, they're going to take that into consideration, but it could be a great option if you are not going to do the loan forgiveness to be able to drop your loans down to a rate that's going to be a little bit more reasonable. Because now if we're at that 3 to 4%, then we're in a much better position to leverage and be able to look at other avenues as well to be able to allocate our money. Okay. One last thing concerning student loans, if there's no other questions, but of course, if you do, just put it in the chat box, is with the new stimulus package, if you guys haven't already, one of the things that they offered was the ability to defer your student loans until September. Okay, so if that hasn't automatically happened for you, then you might want to, if they're federal loans, private is different because it's dependent upon the bank, but if you'd like to, then that's also an opportunity that you can actually look into, call them and let them know. It is a deferment, so interest will not be accruing during this period of time. So just something to be aware of that could help alleviate if you guys are having any stressors, need additional dollars, they're going to allow you to do that, okay? Any other questions on student loans? If not, I'll kind of jump into mortgages. I know there was a couple questions concerning home purchases. This is a great opportunity, even while you're in residency. It's not always a bad opportunity to get into a home, especially if you are just starting out. If there is income available, it fits into your budget, then this could be a great opportunity to actually purchase a piece of real estate while you're building in the place that you're working at, you know, because if you think about, a lot of people move after residency. So this could be something where you're actually building an asset while you're in residency to then, depending on your next steps, could either keep this as a rental property and move into your next home, or it's something that you can sell and it's an asset. But the nice thing is when it comes to home purchases, even though a couple weeks ago, rates did go up a little bit, it was a couple Fridays ago, the rates went up, but from conversations with mortgage professionals, we might actually see those go back down. So that is something to be aware of, is people have, prior to the rates kind of shooting up a couple weeks ago, we were in the mid threes, you know, low to mid threes for home purchases, some even lower if you have really good credit and you have reserves. But that's still an extremely good rate to have, knowing that all mortgage interest is tax deductible, okay? So even if you have a 4% loan, if you can write off the interest, it might be closer to 3% cost because of the interest that you can deduct. So it's still very inexpensive money. Some of the questions that I had seen were, does it make sense to actually build up a large down payment to be able to get in? The nice thing is when rates are low, it's okay to borrow more money. That's that whole debt leveraging strategy, is that if it's only going to cost us 3%, we don't want to have to put too much down. So it actually gives you more opportunity to get into a home faster. Okay. So when we look at that and we say, okay, typically down payments, to not have to pay private mortgage insurance, you have to put down 20%. I will say most people now, there's a lot of different programs, especially physician loans or professional loans that are out there specifically for you guys that will allow you to put much less down. So you can put up to 5% down, no private mortgage insurance, very low interest as long as the rates, you know, start to go back down. So it's managing that. You'll be able to get into a home pretty easily. So we would either, you know, when rates are low, let's borrow more money as long as it fits into the budget, and then put those additional dollars that you were going to have for a down payment into a savings account, or some sort of, if you have your savings account, then to a longer term, you know, investment account or something like that, that's going to give you a higher potential rate of return long term. Okay. Not always in the short term. So there's some great opportunities to get in. And then, like I said, what we find with physicians that do that is they will jump in. Let me see, and then I'll answer that question. Is the down payment is putting that into obviously that investment account. I lost my train of thought there. This also gives you the opportunity to not have to save for so long. So if you're thinking of trying to save for 20% down, but because of the limited resources being in training, it's going to take you a couple years. We don't know where rates are going to be. So if rates are low right now, but they do tend to go up, you're paying now more towards interest for the same purchase price of the home than you would 3 years from now, than if you just got it this year or next year or something in the sooner, and you put less down. So there's opportunities on both sides. So you have to look at your whole situation first, make sure that that your mortgage fits into the budget, And then from there, make a decision on how much you want to put down, but knowing that you do not have to put as much down at the very beginning. Okay.
I was just going to add a little bit to that, Stephanie. I think, for many of you, if you're early in residency and it's a multi-year residency, it is something you should consider if you can financially. Obviously, it's a little bit more difficult as a resident to come up with as much dollars for those kind of things. And it's also a time when it's sometimes difficult. We're trying to understand our own financial awareness about how comfortable we are with leverage. Because there's obviously other costs that you're going to incur as a resident. You're not necessarily going to be able to move your income up significantly, even if you can moonlight. But it is, especially if you're in one of these longer track specialties, surgery, neurosurgery, whatever, 4 or 5 years, the equation changes. If you're in a 2-year fellowship, obviously it may not make sense, and you're leaving. But interest rates are historically low now, and the Fed has kind of indicated that they're going to keep them low for a while. So it's a little bit different now than I think some of the classic teachings. So things now have changed. As to the question about coronavirus and the housing market, I think that's a great question. I think everyone is wondering what's going to happen. You've got answers on both sides. Some people think there's going to be amazing, deals, and other people think, and we're in there, a lot of us, Stephanie and I are in Arizona, and we're seeing a huge influx of activity that we thought would slow down, but a lot of people are moving from coastal areas and driving up prices, even though house showings and things like that have slowed down. And so I think it's, as they say, real estate is local. And I think this is, one of those things where, again, it kind of just hits that to, New York real estate has taken a hit, I think, especially New York City, but the suburbs are booming right now. So I think it's, very local dependent there.
Yeah. And one of the, again, it's, you don't want to be as, look at, whenever you're looking in the housing market, make sure you look at both sides of the coin. Make sure you look at the lending and rates and the prices, because I have had clients that come and say, well, I'm going to wait until the housing market drops a little bit. But if it takes a year to do that, and now rates are up to 5% versus 3.5%, it might have made more sense to just buy a higher, a little bit higher priced home, but you're going to get more home than paying more towards interest. So just look at both sides when you're making that determination, because I've had people consider waiting, but then if interest rates are going up, all it means is they're going to be paying more in interest and less towards the purchase price. So weigh both options on that. Absolutely. Hopefully that addressed that question, but if you want additional information, let us know. Moving on, when we talk, again, we talked about cash, it's dead, and it's managing that balance. And I hate to say it, but for the most part, most of the answers are going to be, it depends on the situation. If somebody there's a difference between someone who has $500,000 in debt or 50,000, it's different on what needs to be going towards specific debt versus some of the other things. But if we go into more of the, some of the things that people had questions on, when we look at investments, to take a step back, it's hard to invest while you're in training. There's very limited resources. We're very understanding of that. It's just, we find, people who are in that training process, make sure cash is most important. Making sure you have a good cash balance, you're managing your high interest debt appropriately, having a good plan if you have student loans, that's most important. But then if there's dollars left over, and then we'll talk about the risk management as well, because that's very important of trying to get that established as well. But one of the important things, once you've done that, if you've knocked out all those from a priority standpoint, and there's still dollars left over, there are some options for retirement. Okay, so when you talk about long-term investing, here's some of the basic retirements. These aren't all the investment strategies, but what we find a lot of times is this is kind of the different options that we find for individuals in training. So if we look at this, there's a couple, I'm sure you've recognized some of these. Through your employer is what you're going to find qualified plans. So we're talking about 401k, 403b, if you work in nonprofit. TSP, we found that I do a lot of work in California and with the Navy. They have the TSP, so it's military. You're going to have a TSP plan, a thrift savings plan. These are typically allocated through your employer, and you're going to be able to put away money pre-tax. Okay, so the contribution limit for 2020 is $19,500. It's a pre-tax contribution, meaning that if you're making $60,000 and you put $5,000 into it, you show to the IRS that you make $55,000. So it's a dollar for dollar decrease in your taxable income, which is great. But one thing to be aware of is that if you get a deduction at the beginning, you do not pay taxes on retirement accounts as they grow. When you pull the dollars out at 59.5, which is the rule, then it is 100% taxable. So one of my questions that I always ask is, where do we think taxes are going to be in the future? And this is not a political conversation. It's we're looking at the economy as a whole. And if we look at past history of where taxes have been in the past, since the 1900s, one of the highest tax brackets, is very overwhelming because most people say, oh, 50%, highest tax bracket is 60. It's actually been in the low 90% was the highest tax bracket in the mid 50s after World War II. So then once that occurred, it dropped down to the mid 70s for like a 14 or 17 year period of time. And from there, a 14 to 17 year period of time. So we've seen in the mid 70%. And then if we average out the highest tax bracket in US history, it's actually around 56%. We're at 37%. So if we look at our tax history, even though we complain that we pay a lot in taxes, and that will always be the case, we just have to be aware that if we look at the government as a business, revenue that comes in is taxes. Then we have government spending, which we don't do a very good job of monitoring. We usually spend much more. Whatever is left over is what we obviously use to pay for Social Security, to pay for all these different items that we have in the government spending. And the only way to manage those and to pay these back is taxes. So what was even not a concern, but something to be aware of, is what happened over the past couple months. We just spent unexpectedly almost $2 trillion of money that we have to pay interest on. So if we look at that and we say, okay, where is that tax liability going to go? It's probably going to be higher in the future to be able to pay for all these things that we're doing today. Okay. So when we look at retirement accounts as a whole, the goal isn't to just focus on what you can get the immediate tax liability that we're trying to accomplish. We also want to focus on making sure we don't kick all our taxes that we're going to have to owe to the future, when most likely our expenses are going to be higher, than they are right now, of course. And having that, and if taxes are going to be higher, we're just going to need more money at that point in time. Okay. So when we look at that, that's why we don't want to put all our eggs in one basket. Okay. And that's why we talk about having some pre-tax today to help you today. And it's going to be even more important when you get out of training and now you're making a couple $100,000, if not more. You need that tax deduction. But try not to forget making sure that you also invest in areas that are going to allow you to have some tax-free access, or maybe only taxable on gain in the future. Okay, so all those qualified plans, 401k, 403b, TSP, and I know there's a question also about locum work or other side work. If you receive a 1099, okay, so when you're a resident, you receive a W-2. And they take out your taxes. If you receive a 1099, you are considered an independent contractor, and the employer that just paid you that 1099 income, they do not take taxes out for you. So if they do not take taxes, you are considered a 1099, which means being an independent contractor, you have the ability of doing a SEP IRA, which because you're considered self-employed, okay? So any individuals that have, through work, you're going to have the 401k, 403b, 457 TSP. If you're self-employed, you have the ability of creating either a SEP IRA, which is much less an expense to administer. So usually we recommend that. Or technically you can create, if you have a lot of income coming in from outside work, you can set up a solo 401k. hopefully that addresses your question there. Is you can either do a SEP or a solo 401k. SEP IRA, you can only count 25% of that 1099 income, okay? You can only count that. If you do a solo 401k, you can actually contribute up to 100%. So that's the big difference between solo and SEP, but a solo 401k is more expensive to administer. So you're talking about costing maybe a couple grand a year, maybe a little bit less, maybe 1,500, but it's going to cost you a much more. Whereas a SEP IRA costs you $50 a year to have the account. Okay. So most likely if, you know, we do have somebody that's still in training and has some outside work receiving a 1099, we can set up a SEP IRA for them pretty easily.
I'm just going to make one comment on that. The downside of the SEP IRA is if you want to convert later, do the backdoor Roth IRA conversion. Many of you guys may be aware of it. You have to have a zero basis. And so you will have to pay a penalty or you'll have to convert what's the balance in the IRA, the SEP IRA, to the Roth account. And then you will have to pay tax on that. So if you're trying to do a backdoor Roth IRA as you get further into your attending career, you need to have a zero IRA balance at the end of the year on all outstanding IRAs.
Yeah, absolutely. And one way we also have done that is you can move your SEP into your current 401k.
Right.
So if you move to once you get into training and you move into that new place, if they have an established employer plan, you can move your SEP into that. And then we do the backdoor Roth, which is something that we do. Absolutely. One of the questions was with retirement accounts, is it complicated if you're 1099 independent contractors through an LLC? We actually, if you have a lot of income that's coming in at least 3,000 to 5,000 or above, we usually recommend establishing a corporation so that you have a little bit of a line of defense there. But it doesn't make it more complicated at all. It's actually very similar, but instead of the title being you as an independent contractor, it's just the title of your LLC is the employer in a sense. So there's no difference there or anything, but what it does is if you are an LLC, not to get too complicated, and you're taxed as an S corporation, your S corp, that S corp status splits your income into W-2 and draw, if that's, you know, and so the SEP IRA, they only look at, and the SEP IRA and the solo 401k, but it's 100% on the solo 401k, that's only considered of your W-2, which is why it's on the slide. Okay, so they do not count any of your draw as part of that amount that you can then take 25% to do a contribution. And again, it's above and beyond kind of for today's conversation, but if you do have additional questions, let us know on that. Last of all, when it comes to retirement plans, obviously on the other side, we talked about all this side is pre-tax. When we look at the other side, Roth IRA, as Dr. Patel mentioned, is, you know, one of the most efficient vehicles out there, which is why even when you're not in training anymore, we see a lot of our physicians do those backdoor Roths. So the reason why is because it's an after-tax contribution, okay? Money grows tax deferred, but when you pull the dollars out at retirement at 59.5, it's 100% tax-free. So it's one of the most efficient vehicles out there because all gain is actually tax-free in the future. So it's really nice if you can diversify out and have pre-tax money and after-tax money in the future, because it allows you to pick your tax bracket in the future. So if taxes, just to make it easy, are 50%, you need $200,000 to live in retirement. You pull $100,000 out of a 401k, $100,000 out of your Roth, you only have to pay taxes as if you earned $100,000, not $200,000. So you're saving a lot in taxes in the future, and it allows you to actually decide if you want to pull more pre-tax, pull more after-tax in the future, and then you get to pick, in a sense, your tax bracket from there. One of the things to just be aware of is that Roth IRAs, as he mentioned, there's a reason that people have to do the Roth IRA conversion or backdoor Roth, and that's because of income limits, okay? So if you make the ones that are on the screen over 139,000 or 206,000, if you're married, we can't do one the traditional way, okay? And that's when we have to start looking at other avenues like the backdoor Roth or Roth conversion is what they're called, to be able to sustain that and be able to continue to do that. But there's stipulations, and you have to absolutely know about that as well. Any other questions there? Oops. So that's kind of on the investment side. Last thing is that when it comes to what you're going to do, think of it as right now, your income is the lowest it will ever be. Not that that's always a good thing, but it is the lowest that it will ever be. So when we look at the plans, a lot of times, again, depends on the situation, but most likely we'll lean a little bit more towards Roth IRA contributions instead of pre-tax, unless there's any type of match through your employer. So if they're going to give you free money, they're going to give you 3%, 5%, whatever it is, to put money into your account, take the free money. So then let's at least get that 3% in, or whatever that match is. But anything else, because your income is low, let's take advantage of the opportunity to be able to use the Roth IRA as a way to build that up. It's not like you can contribute as much as the pre-tax options. You can only get $6,000 in, but it's still a great opportunity to get more money in and to save for that tax-free access in the future. Okay.
Stephanie, I was just going to bring up one point, and you can comment on this, is some places now, especially for those who are in training at many of these larger medical centers, are offering Roth 401ks.
Yes.
What are your thoughts about that?
I love them. That's kind of the new way that's become very popular, is that, and when we even establish for our practice owners a 401k, we always add in the ability to make a Roth 401k contribution. They work exactly the same as a Roth IRA in a sense of how they're taxed. But the great thing about a Roth 401k is that the limit, or the amount that you can contribute, is the same as a 401k. So you can get $19,500 in, which is amazing. But there's no income limitations. And so that's where we find that even if you make a couple $100,000, you're farther along, that's when you start to determine, am I okay taking the tax hit today, even though I'm in a higher tax bracket, making more money, so that I can have that tax freedom in the future. Okay. So that's a really big opportunity that if you have both, we've seen clients that do half and half. We've seen clients do fully max out this is while they're in practice, max out their 401k and then do the Roth IRA conversion and some other options to be able to get the after tax. So it's really up to you once you actually get to that position to be able to do it all, or if you can now, is looking at your tax situation and trying to decide what you want, what you feel comfortable with. Okay. So that's kind of on the retirement accounts. Last couple slides is really on the defensive planning. Okay. When we talk about this, it's not the fun stuff, I know, but at the same time, it's things that are very important to start to think about, because you guys are in a position, you have external risks is what we call them, because you guys are more likely to get sued. Okay. Unfortunately, the minute somebody finds out you're a physician, they think you have all this money just like hanging out, waiting to be spent. And I know that's not the case, but that's what people make that assumption. So we find a lot more people are sued in a position like yours. Okay. So when we look at the different types of risks that are out there, we have internal risks, external risks. External risk, you guys are very much aware, personal, professional, we're talking about malpractice. If you were to be sued at work, that's why you have malpractice, okay? When we think of external risks on you personally, then that is one thing where we look at there's car insurance, there's homeowners insurance. Umbrella is something that not very many people are aware of. Umbrella coverage, so for example, it covers you, it's an umbrella over you personally. Okay, so it's one of those different types of insurances because we only want our clients to insure themselves, meaning outsource to an insurance company for things that would be catastrophic to your situation. If it's something small, and it's like, oh, my phone breaks and now they're more expensive, so maybe you do want phone insurance, I don't know. But if that's the case, a lot of times we want to self-insure. That's why we have the emergency reserve, is to cover the unexpected things. We don't want you to have insurance for everything. But if it would be detrimental to your situation, we've got to outsource that to an insurance company to pay for that. So when we look at umbrella coverage, think of it as malpractice over you personally, okay? So for example, car insurance, okay? One of the things to be aware of is your limits, knowing your limits in car insurance. Typically they're gonna be 100,000, 300,000, meaning if you get into a car accident, it's your fault, one other person in the car, the most the insurance company is gonna pay out is 100,000, okay? If there's multiple people in the car, the aggregate amount that will be paid out is 300,000. Okay, so when we start to think about that, 100,000 in a car accident might not even cover the cars, let alone a true injury. So if you were to be sued for $500,000 because of medical expenses, loss of income, and the accident as a whole, 100,000 would be paid out, and then the additional 400,000 would actually go towards your personal assets. Okay. And I hear a lot of residents when we do these talks say, well, fine, sue me. I have a bunch of student loans and I have no assets. You can sue me all you want. You can't take anything. So we do hear that. But I will say, dependent on your state, okay? There are states inclusive of, I know California, I know Nevada, I know Arizona, is that they will actually, if somebody really wants to get their money, they can actually garnish wages up to 25% of your future earnings, meaning when you transition into practice, they can garnish up to 25% of wages to be able to pay that off. So that's why we have an umbrella policy, which comes in increments of $1 million, very inexpensive because the likelihood of it actually happening is very low, but would be catastrophic to your situation. You get it through your car insurance, you know, or your renter's insurance or your homeowner's insurance. It's nice because you added on another line. So usually there's a discount, and it probably will cost you, for $1 million of coverage, will probably cost you 15 to 20 bucks a month. Okay. $200 a year, $200 to $250 a year. Very inexpensive coverage. We hear a lot of, you know, asset protection is thrown around a lot with physicians. And this is the simplest, most inexpensive way of covering you before you start talking about trusts over here. You know what I mean? A lot of different offshore trusts. People talk about that all the time. And some of the most simplistic ways of covering yourself is making sure for work, you have high levels of your malpractice. Personal, you have an umbrella policy that covers you. It comes in increments of $1 million, start with $1 million. But we've seen individuals go up to 2, 3, 4 million. So someone has to sue you for much more than that to even touch your personal assets. So it's a very important thing. It doesn't have to be done tomorrow, but something to start to consider in your overall financial picture as a way of protection, okay? When we think of internal risks, now we're talking about the insurances towards you as an individual. That would be catastrophic. You guys are very aware of health insurance. You guys work in the environment. You know the cost of healthcare. So it's so important. That's why it's mandatory to have health insurance. But when we look at some of the other insurances that you guys had questions about, you know, the disability, you hear it all the time. And it's one of those things that is extremely important, absolutely, is knowing what you have or what's being offered through your work. And then, of course, making sure that you know exactly what's out there when it comes to individual policies as well, okay? Because there's a huge difference. People have a false sense of security with their insurances that they have through work. But one of the most important things to look at when you're looking at these benefits is the definition of disability, okay? So if we look at that, the definition of disability for group policies, most group policies say if you become disabled, we will pay out a benefit. Sounds very straightforward, but what it doesn't say is that if you become disabled and can work in any other field, so you cannot be a specialist, you cannot be a physician, but you can teach, but you can do anything outside of that, it will not pay out a benefit. You know, so we've seen extreme measures. So I would say 95%, we even did a podcast with Dr. Patel on this, 95% of group policies don't pay out, because a lot of times the disability doesn't allow you to be a physician or work in that environment, but it allows you to do many other things, okay? So it's just something to be aware of. So then when we look at private coverage, okay, so private coverage, individual coverage that you're probably bombarded by emails all the time about and trying to find what's good, what's bad, pretty much, is, again, goes back to the definition of disability, where we look at specialty specific definitions of disability, meaning that if you cannot do your specialty, we will pay out a benefit. Very important, because if you can teach, you're still not able to do the substantial duties of your specified occupation. So then it will pay out a benefit and you receive the income from your other position. Okay. So that's one of the big things. The other thing, the difference is about group, is that group insurance is taxable because the hospital is writing it off. And a lot of times it's a percentage base. They'll say, we'll give you 50, 60% of your income up to a specific cap. Okay. And the caps sometimes are only 10,000. So if you're making more than that, that's a pretty low cap. Okay. But the other thing is it's taxable. So if you're receiving 50, 60% of benefit, but it's taxable, now what comes into your situation is probably closer to 30 to 40%. And the big question is, can you live off of that? And most of the time you can't, you know, from what we've seen. So that's something to be aware of. Individual coverage is 100% tax-free. It's a specified monthly benefit, so it's not a percentage, you pick it. While you're in residency and fellowship, you can get anywhere, dependent upon the company, between 5,000 is cap for a lot of companies. Sometimes in your last year, they will allow you to get up to 6,500. Tax-free monthly benefit. Okay.
Stephanie, just to clarify, it's tax-free because you're paying pre-tax. I mean, sorry, not pre-tax. You're paying post-tax the premium, right?
That's exactly right.
You can choose to do it pre-tax if you wanted to, could you not?
You know, interesting enough, I have seen only a couple clients. I've told them all the issues there, right. But you technically can, if you're a practice owner and you want to write off your disability insurance, you can write it off.
Right. Just to clarify, but yeah,
yep.
Mostly you should get it post-tax. So.
Yeah, because if you think of it as, if you take a tax break here, your taxable benefit or your benefit becomes taxable. Right. So it's like, do you want to pay the taxes on the $6,500 that you have, or would you rather just not the couple $100 a month? Would you like to do that? You know what I mean?
So it's like the Roth IRA kind of thing. You pay the tax.
Exactly. Absolutely. And that's how the hospital is able to, you know, take their deduction and allow you to pick it up as taxable. So those are some of the big things to be aware of. There's a lot of different riders that allow you to increase without having to go through underwriting again. It's called a future purchase option. Residual riders mean that you don't have to be 100% disabled to be able to collect benefit. If you're at least 20, depending on the company, 20 to 25% loss of income, loss of time, they will pay out a partial benefit. Okay. When it comes to residents and fellows, I always say there's a lot of discounts that you can receive. That was one of the questions. There are many discounts because we specialize in working with medical professionals. We actually, across the country, we have discounts in most training hospitals. So that's something to be aware of, is that you can get at least a 20% discount, but even for some, they have what's called a gender neutral, because it is more expensive for females. They have gender neutral rates. It's not for everyone. It depends on what hospital you're in, on whether they're offering it or not. But that's something that we actually shop out, is we do a disability comparison for our clients and say, here's the top 6 carriers that are, or 5 or 6, depending on the state, on your state for your hospital. Here's the pros and cons of each. Which one do you want? Okay. So it's really nice that we can provide that type of review for anybody. So if that's something you guys are interested in, we can go into more detail because pre-existing medical conditions, that was another question, they do affect your policy. Okay. One of the things we found, I had a client who tore her ACL skiing, totally fine. And that was a couple of years prior. She now has an exclusion for her right knee. Okay. So there's really specifics. I had a guy who played football and he tore his shoulder. His shoulder now is excluded, his one shoulder, you know, so there are pre-existing issues where they'll actually exclude things. A lot of times it's not a full denial. They'll just exclude the pre-existing conditions, but we have to look at that because there are certain hospitals that also have what's called GSI, ones that are called guaranteed standard issue, where you can actually not have to go through underwriting and get a clean policy. It's usually, there's limitations to it and stuff. So if you have a clean bill of health, a lot of times we say go through the underwriting because you can get more. The writers are higher, the future purchase options are higher, but there are ways to still get a clean policy depending upon what hospital you're working at. Okay. Any other questions there?
I was just going to ask one, Stephanie, sorry. So we talked about the hospital policies, we talked about individual policies. Mm-hmm. Your thoughts on the association, like the medical AMA or your, your specialty society policies?
Surprisingly, we haven't found one strong, and we work with all medical specialties. We haven't found a strong policy through the AMA, okay, American Medical Association, or any other specialties. So we haven't found, the reason for that is their definition of disability is still not as strong, because technically they're still considered, even though you pay for it, you get a discount because you get it through the association, they're still considered group policies. A lot of times, so we've even had, we were working with the Arizona Veterinary Medical Association, or not Arizona, American, and the AVMA, and they actually got rid of their disability insurance. And it actually affected every policyholder in some way or form. So it was very interesting, that just something to be aware of, but specifically for the association, for the AMA, their definition of disability is not as strong. It doesn't have that specialty specific language. The only times we've seen specialty specific language at certain hospitals, I know Kaiser in California has specialty specific language, but if you read the fine print, and that's the most important part, is they say it's specialty specific language for the first 5 years. After they've paid you out for 5 years, if you're working in another position, they stop payment. So technically it's actually considered more of a 5-year unless you have a true disability. So it's something to be aware of with these associations is the definition. It's less expensive, you get a discount, definition of disability is the key. So we always look at each individual association, compare the definition of disability with the individual coverages. If it's a strong, I just haven't come across it, and that's all I've done for 15 years is work with medical. So it's really hard to say, but you never know. But is always looking at that definition of disability. That's key. Because then whether it's inexpensive or not, then don't pay it. If it's a 90% chance of not paying out, it's not worth the money. So either get good coverage and make sure that it fits, or just, you don't have to provide for your whole expense. You could just partially provide. If you can't afford the $5,000 or the $6,500, get a $2,500 one, monthly benefit, anything to help supplement your income if heaven forbid something bad happens.
Okay. I was just going to say one more thing. This is what I do, and you can kind of comment on this, is that when I learned about all this stuff, and I went through a broker at the time after training, is basically, you'd like to get an individual policy, with as much coverage as you possibly could. Mm-hmm. Obviously, everyone's situations are different. I'm in a higher paying specialty, so I tried to max out as much as I could. And then you decide, because then you can still get more coverage through your employer, the post-tax, through the hospital, whatever. And so you can kind of stack some of these things too. Yes. There's a cap, but so it's not just an all or one kind of thing. So just to kind of keep that in mind, is you can mix and match a little bit as you need to, but try to get as much individual as you can, because that's generally the best coverage that you can get. And
that's why we recommend getting individual coverage while you're still in residency and fellowship, because they do not count any group coverage. So they give you the full amount. And then what happens is you move to the hospital after you've transitioned, they have a specific amount of group, they can't deny you. So you get your full individual, and then the group stacks on top. If you actually get disability insurance once you've already transitioned, and then you apply with an individual disability company, they're going to count your hospital group, whether it's good coverage or not, they're going to count that 50-60% on average. So then you get a much smaller individual amount because there is a cap. So be aware that that's why we always recommend, yes, when you're younger and you're healthier, but even more importantly is because there's discounts, and because then you get full individual coverage without having group get in the way of, minimizing that for you. Okay. Last of all, I did have a couple questions, but I'll just touch upon the life insurance. Life insurance, it's a want, not always a need. You have to make sure it fits into your situation and what you're really trying to accomplish. Life insurance, what is the purpose of it for you? I think it's looked at, there's a lot of negative connotations out there about how to structure life insurance. We hear it all the time from our physicians, like there's permanent versus term. Permanent has an investment value in it. For some, it might make sense. For others, it doesn't. Okay. And you have to be very careful of who you work with, because how you structure the policy determines how well the policy obviously is going to do. And so when you have conflicting, insurance companies make more money if you have bigger death benefits, but if you want to use it as an investment, you actually need a smaller death benefit. That's why there's a lot of gray and a lot of negative thoughts out there when you Google these types of things. It doesn't mean it's bad. It just means it has to fit your situation. If you're older and it's, the cost is higher, then it's not that great for, you might as well invest into an investment account. But there's a lot of different ways to structure. I know there was a couple, I don't know if they're online today, but there was like whole life versus term. Right now, while you're in residency, if you find life insurance to be a need and you want to lock in your insurability, meaning your health and how young you are, term insurance is a great way to go. Very inexpensive. It comes specific period of time. So it's like 5 year, 10, 20, 30, and it's a level premium. You're talking about maybe being able to get $1 million for 30 bucks, 40 bucks a month, maybe, depending on the length of time. So it's a very inexpensive way to lock in the insurance, but we always add, for anybody that's in training, a convertibility to allow you to convert to a permanent policy in the future if you choose to do so. Okay, so it gives you options. But when it comes to life insurance, it just makes a lot of sense to really know what you're trying to accomplish long-term with this, because it can be structured in many different ways. And so it's very similar to disability. There's great companies out there. There's bad companies out there. Do you want permanent insurance? Do you want term insurance? Or do we want term insurance with the ability to have an option to convert in the future? So that's very much, depends on the situation. One of the last things I'll say about life insurance is people ask, how much should I get? They don't know, and I think there's really two ways to look at it. Number one is what we consider like our cost-based, meaning we add up all the costs of what you would want to replace. I want to pay off my mortgage. If you had kids, I want to make sure they're taken care of and their college is paid for. I want to make sure my spouse is taken care of, or any family. And then you just add up those numbers, and that's how much insurance you should have. I will say for younger individuals, hence like people still in training for the most part, it's hard to say, if you're not married and you don't have the kids yet, or, you haven't purchased a home, you don't really know what that cost is. So I will say the other rule of thumb is typically 10 times your income, future income, 10 times your future income will replace that same income for between probably 12 to 15 years. So if you look at it and you make 200,000, $2 million, 10 times that, $2 million would replace $200,000 for about 12 to 15 years. Okay, so sometimes it's an income stream that you also want to manage because you don't know your costs yet. So those are just a couple different ways to think about it. But like I said, it really depends on the individual of what you're trying to do. Okay, last thing, just so we're good on time, is contract review. Okay, so if we look at that, these are the three main things. When we look at a contract for our clients, we look at the financial aspect. We look at a couple of different contracts that we're given, because one of the big things is the first thing people look at is the income. What am I going to make, right? Salary is a big deal. But what they tend not to look into the detail or be able to put a dollar value on is the benefits. So we always want to make sure that's where we look at contracts from a financial situation, because even though, for example, I use Kaiser for benefits because they have some of the strongest benefits out there. But so their income is competitive, but their benefits is like through the roof if you stay with Kaiser. If you can stay there at least 10 years, they have the most amazing benefits, pension plans, depending on where your location, Northern Cal, Southern Cal, it doesn't matter, in some of the other states. But for example, they have great benefits. That's not always the case for all, for all hospitals. So that's why you always want to put almost a dollar value on your benefits in addition to your income to decide if it's a good fit. Okay, so that's how we look at it from a financial standpoint. When it comes to true contract review, I've had a lot of people say, should I hire an attorney? Because it's going to cost me anywhere between, I would say, $300 to $500 to have a contract review, a formal contract review. I will say because of cost, you know, if you can, absolutely. But if you're like debating, we look at it as a, you know, a hospital, large hospital group, and not private practice versus private practice. Private practice, I honestly would say if you have the money, please have a contract review, you know, have it reviewed by an attorney, because it is private practice. A lot of times they don't, if it's a smaller group, they might not even know everything that they should be putting in a contract. You know, they've done the best that they can. So you want to make sure that you can negotiate that a little bit better. When you're dealing with hospitals, it's interesting. We were looking at one here in town at Banner, and they're so standard, you're not going to be able to negotiate too much. Like, you might be able to negotiate salary and some of those things, but they are very standard. I've even seen a contract where they just X'd out somebody else's name and put somebody else, like, blacked it out. Like, it's not saying that's good, but I'm just saying we have seen it so standard that, yes, if you think it's worth it and you want to negotiate a little bit, then yeah, hire an attorney. But you're probably going to have less, you know, flexibility in your, you know, in those types of contracts. So if everything kind of makes sense, there's very little room for them to actually make big changes. Not so much to the salary and the benefit, but like to everything else. It's a very standard contract. So it's kind of up to you what you want to do there. I'm not going to say don't do it. I'm just going to say, look at your budget, see if you can afford it. I'm less worried about that than I am private practice. Okay. Some of the last two things were non-compete clauses. I know that's what people hear a lot of times. Surprisingly, things have actually moved a little bit away from non-compete clauses, in a sense where instead, where they say you can't compete if you decide to quit prior, you can't compete, meaning you can't work in a specific area, whether it's 5 miles or 10, you know, whatever that amount is. Sometimes they still have those, but what we've seen is be aware of those is all. Is just know, so you know if something did happen, you don't like where you work, that you can actually leave and it's not going to affect you and where you work. Okay, the next place. But they're moving towards liquidated damages. So be aware of that. Okay. And what that means is instead of them putting a guideline like you can't work in this specific area, they're like, great, you can set up shop next door. Totally fine. But because we helped train you, we helped get you to become a better physician, you owe us, if you obviously quit early or something, you're going to owe us $200,000 in training. And it can be a big number. Sometimes we've seen 50, sometimes we've seen $250,000 because it's more of a scare tactic. I'm not saying all of these will completely hold up in court, because that's another big thing, is they're becoming less and less, it's less and less advantageous. They're not, but that's how they're moving. So then there's less work. They just say, great, you quit early, you owe us this money. So just be aware of that as well. That's something we find in contracts, just so you have an understanding there. And last of all is tail coverage. This is a very, very important thing to just know what you have, okay? What tail coverage is, and as you can see on here, is that if you were to be sued, if something happens, you leave, you go to another place, and something happened, you know, because you know as physicians, things are delayed, you know, and somebody sues you, you have to know who's going to be sued, right? How is this going to work? And that tail coverage means that you actually, if you get sued from a previous employer, they will help cover that. Your tail insurance, in a sense, will help cover that, okay? So it's just something to be aware of, because you want to make sure you know. We've had, unfortunately, people didn't pay attention to that, and they had to pay a very big bill because they didn't realize that they weren't covered, okay? So tail coverage is a very important thing to think about. But other than that, like I said, reviewing it, whether you use an attorney or not, to kind of give you an overview, that was kind of the last touches that we wanted the main things to focus on. But if you did have individual questions, let me know. But for the most part, whether you use an attorney or not, it really depends on your situation. But try to narrow it down a little bit more, because it is a little bit expensive. Like I mentioned, it's between that $300 to $500. But that was kind of, yeah.
I was just going to add, I think Stephanie's absolutely spot on this. These large institutions, they're usually very inflexible. It can vary though. If you're one of many physicians of a certain specialty, they're probably not going to change it. But if you're like the only, cardiothoracic surgeon, yeah, even if they're coming in, they're going to be more likely to change it, because, you know, it's just a little bit more of a niche. They might need you more than then you need them. So that's a little bit variable, but yeah, on the most part, the bigger the institution, the less flexible, the more standard boilerplate kind of contracts that they have. Tail coverage is a huge one, especially if you're in a high risk field or a high risk state. Many physicians have been on the hook for, a couple $100,000, and you can, when you're looking at your next position, that can be a determining factor if the next group hires you, because they don't want to be, on the hook or have, there's a thing called nose coverage that can also kind of cover that. But they don't want to be on the hook for that. So big things. It's good to hear about the non-compete thing. I think the country is kind of moving towards that, but it is state to state dependent also. So certain states are very much more pro the employee, and other states are much more pro the employer. So that also, again, is a little bit state to state. But this was good. I think great overview by Stephanie on all the topics. And I think if we can stay on if anyone's got some questions, that they want to either just, ask by voice or on the chat. Go ahead.
Yeah.
This is your time.
Absolutely. And that's kind of like, the goal for today was really to give an overview of a little bit of each, right? We didn't dive down into a lot of the different topics. And that's what we're here for, is like, obviously we're in a unique situation. Normally we'd be doing this in person. Now it's more webinar based. But the goal would be to really, obviously, we're here to build relationships, and that's what we do. We work with a lot of residents. We help them through their last couple of years to help them with that transition so that they actually have a plan in place before they make that transition. So then when you do finally have that increase in income, then what you find is that it's much easier to take 20% off the top and save, versus if you already bought the nice house, you already got all the things that you wanted, all the toys you wanted, right when you started making that income. It's a lot easier to save early when you've never seen the income. And that's why we do these types of presentations, is because we want to build these relationships. So what we're going to do is, again, hopefully everybody got there, and then I'll jump in. Yeah, absolutely. But yeah, that's the goal, is we'll send out an evaluation, like just an email. Let us know what your thoughts are. It'd be great if you did respond, at least say yes or kind of answer the questions, because it also gives us, for compliance, since we sent out those gift cards, making sure that we did actually host something and we just didn't spend money on ourselves. So it allows us to have that feedback. But one of the questions was how to hire a fiduciary advisor. What are typically the costs? So thank you for segue into that. We are comprehensive fiduciary financial advisors. Okay, so I think how it works is really, when it comes to costs, there's a couple different things. I think a lot of times how we work with residents and fellows is that even though we're a fiduciary advisor, which means that you charge a transparent retainer, okay? That means you're charging a fee that is a flat fee to be able to advise you. And so when we work in that format with our physicians that are out of training, what we did decide to do, because of the amount of work we do with residents and fellows, is that we would take that expense on ourselves, meaning we would not charge our retainer, but instead do almost a hybrid of education, just a couple meetings of things to start to think about, with the thought process that we're starting a relationship. If we're adding value, that the goal is, as we continue that, when you make that transition into practice, we're still going to be able to help you on that level. But when it comes to costs, true costs, if you're working in that retainer environment and not in training, so you made that transition into practice, we have foundations, foundation level plans that start at, even though it's an annual retainer, we actually charge it on a monthly basis, so you don't have to take away from cash flow. A lot of our residents want to, start to build cash, so the last thing we want to do is take away from that. So it starts at $150 a month, but then different levels of service, and it continues to go up from there. So that's that. But at the beginning, like I said, what we do in that email that we'll send out is just let us know if you'd want just a complimentary quick call to just get to answer any individual questions that you have. And of course, if there's opportunity for us to help, then we can kind of work in that format, like I said, where it's more of a hybrid, where we give a meeting or two of education and just quick recommendations to think about while you're in training. And then once you make that transition, then we do more of a formal meeting to see how we want to work together. But as of all, not just us, fiduciary advisors, what that means is they're fee planners. They're charging a retainer. And what that does is working with a fiduciary advisor just means they're held to a higher level, a degree, because we have to legally be bound to do what's best for our clients. And surprisingly, that's not always the case for that. And so there was, if you have any other questions, let us know. But there was one other question. If long-term disability insurance premium is paid by the group 50% and by the individual 50%, is it group? It depends. It depends, because it depends on how did they do it for everybody, or did you personally get underwritten as an individual, and they're just paying 50% of it. Okay. So that's kind of the determining factor. If they did a full underwriting on you as an individual, it's truly considered individual. Where group comes in is they blanket it. So they just look at your age and what your position is. And then from there, and your income, of course. And then from there, they just do a group pricing when it comes to disability insurance. And then because of the expense, that's why you don't get a lot of the bells and whistles on the group policies. It's because it's expensive. They have to offer it. An employer has to offer it to everybody. They cannot discriminate. So that's the deciding factor on whether it's group or not, is if you were individually underwritten for it or not. Okay. But yeah, that was, we'll be here for a couple minutes for any additional questions, but that's, hopefully you got some information out of the conversation today. And like I said, we'll be following up to see if anybody has any additional questions. Like I said, if you want the website or the student loan specialist information, we can send that out as well. Just let us know, just respond back to that. But hopefully you got some value from today.
And Stephanie and I have been doing a series of these webinars. So we've done one on estate planning, and we did one on starting a practice. And so, keep on the lookout. I posted in the Dr. Money Matters Facebook group when we're doing these as well. So just, we're trying to do topics kind of on a rotating basis of what's important. Obviously, this is the time of year when people are starting residency or starting new, attending positions. So we thought this would be timely now. But if you have any suggestions on things that you would want to learn about, definitely, shoot me a message or Stephanie, and, we'll try, if there's enough interest, we can hit some of those topics also.
Absolutely. And the emails that that we had sent out, obviously, and when I respond, I'll also put, even though I put Dr. Patel's website in the previous emails, I'll make sure to add that in for Dr. Money Matters as well, because there's some great information on there. On all these different topics, not just on the financial world, but like in real estate and a lot of different moving parts. So I think it's very advantageous to have, a group of individuals. That's been so nice of Dr. Patel, is to have a group of individuals that are medical, that are dealing with this, that can actually attest to a lot of these things because of experience more than anything, versus just me speaking. So we appreciate that as well. So I'll have that in the email for responses, just so you can also take a look and hopefully subscribe.
Perfect.
Awesome. Well, you'll be sharing the link. Yes, and so we did record it. So Dr. Patel.
We'll post that up also.
We'll post, okay.
Yeah.
So that will be posted as well, so that you have that. All right. Well, thank you so much. And you guys have a great weekend.
All right. Thank you, everyone.
All right. Thank you.
Thanks, Stephanie.
Okay.
I'm going to hit this, or you can hit the stop and
yeah.
Good.